You woke up this morning and checked your bank account, saw some numbers on a screen. Maybe you felt good about them, maybe you didn't. But here's what you didn't see. Those numbers aren't money. Not in the way your grandparents understood money anyway. They're entries in a database, promises on a ledger, digital ghosts of value that most people will never hold in their hands. And right now, as you're watching this, 97% of all money in existence is exactly like that. Not printed, not minted, not stored in a vault somewhere, just recorded. Welcome to the shadow economy that moves $50 trillion a day without a single banknote changing hands. Let's start with a number that breaks most people's brains. In the United States alone, there's about $21 trillion in the M2 money supply. That's checking accounts, savings accounts, money market funds, basically everything we think of as money we can spend. But here's the kicker. Only about $2 trillion of that exists as physical cash. The rest? Pure data. And that $2 trillion, most of it isn't even in circulation. It's sitting in bank vaults and ATMs, waiting for the rare occasions when someone actually needs to touch their money. The average person walking around probably has, what, 40 bucks in their wallet? Maybe less. We've been living in a cashless society for years. We just didn't notice because the transition was so gradual, so convenient, so thoroughly disguised as progress. So how did we get here? It started innocently enough, like most financial revolutions do. Banks in medieval Italy figured out something clever. If you deposit gold with us, we'll give you a paper receipt. You can trade that receipt instead of lugging around heavy metal. Genius, right? Except banks noticed something interesting. Most people never came back for their gold at the same time, so banks started issuing more receipts than they had gold in the vault. This is called fractional reserve banking, and it's been the foundation of modern finance for centuries. Today, that same principle operates on steroids. When you deposit $1,000, your bank is required to keep maybe 10% of it, sometimes less, and can loan out the rest. That loan becomes someone else's deposit, which gets loaned out again and again. 1,000 real dollars can become $10,000 in the system through this multiplication effect. It's not a conspiracy. It's not even a secret. It's just how money works now. But the real magic trick happened in 1971. Richard Nixon did something that still echoes through every financial market on Earth. He severed the last connection between the dollar and gold. Before that moment, your money was theoretically backed by something physical. After that moment, it was backed by trust. Trust in the government, trust in the Federal Reserve, trust that everyone else would keep trusting. And here's the uncomfortable part. It worked better than anyone expected, actually. Turns out you don't need gold bars in a basement. You just need everyone to believe in the same shared fiction. Money became information. Information became money. And once money became information, it could move at the speed of light. Today, the global financial system runs on a network most people have never heard of, called SWIFT, the Society for Worldwide Interbank Financial Telecommunication. 11,000 banks in 200 countries sending encrypted messages back and forth, moving money that never physically moves. When you wire money internationally, you're not sending dollars across the ocean. You're sending instructions. Bank A tells Bank B, reduce my account, increase theirs. Bank B agrees. And just like that, value has transferred between continents in seconds. No trucks, no planes, no briefcases full of cash. Just messages between computers, updating databases, shifting numbers from one column to another. Last year, SWIFT processed about 45 million messages per day. That's 45 million transactions where money, quote-unquote, moved without anything actually moving. Now, here's where it gets weird. Remember that 97% figure? The money that only exists digitally? Most of it never existed in physical form to begin with. It was created the moment a bank approved a loan. Think about that. You go to buy a house, the bank approves your mortgage, and in that instant, through the mechanisms of fractional reserve banking and digital ledgers, new money springs into existence. The bank doesn't take money from depositors and give it to you. It just updates your account balance and expects you to pay it back with interest over 30 years.
You'll spend decades working to repay money that wasn't real until you asked for it. The economists call this credit creation. The rest of us might call it something else. But wait, it gets more abstract. Central banks don't even pretend to deal with physical money anymore. When the Federal Reserve wants to inject liquidity into the economy, like they did during the 2008 financial crisis or the pandemic, they don't print trillions of dollars and helicopter drop them into cities. They create reserves in the banking system with keystrokes, literally just updating numbers in digital accounts that banks hold with the Fed. Between 2008 and 2014, the Fed created about $3.5 trillion this way. It's called quantitative easing, which is a deliberately boring name for something that should probably sound more dramatic. Creating trillions of dollars by typing on a keyboard. The money supply expands, asset prices inflate, and somewhere someone's retirement account goes up, while someone else's grocery bill becomes unaffordable. All because of numbers that never existed before someone decided they should. Now you might be thinking, this sounds unstable. And you'd be right to think that. The entire system runs on confidence, on the collective belief that these digital entries represent real value. But belief is fragile. In 2013, Cyprus had a banking crisis. The government responded by freezing accounts and taking money directly from deposits to bail out banks. People woke up with less money than they went to sleep with, not because they spent it, because it was simply erased from the database. In Lebanon, in 2019, banks limited withdrawals during an economic crisis. Your money was technically in your account. You could see the numbers on your screen, but you couldn't access it. What's money worth if you can't use it? These weren't theoretical exercises. They were previews of what happens when the invisible empire becomes a little too visible. And here's the irony that nobody wants to talk about. Cash, actual physical cash, is disappearing faster than ever. Sweden is trying to become completely cashless by 2030. Some cities in China are already there. During the pandemic, many businesses stopped accepting cash entirely. For health reasons, they said. But once that infrastructure is gone, once the ATMs are removed and the cash registers are retired, there's no going back. You'll own nothing physical, just permissions in someone else's database, and permissions can be revoked. China's already experimenting with a digital yuan that gives the government complete visibility into every transaction, every purchase, every transfer. It's perfectly trackable, perfectly controllable, perfectly erasable. The ultimate expression of money as information rather than property. So what happens when the next crisis hits? When confidence wavers, when servers go down, or sanctions cut off access, or a bank decides your account looks suspicious? Your money doesn't disappear into thin air. It never was in the air to begin with. It just gets updated, adjusted, frozen, deleted, and you'll stand there staring at your phone, wondering where your wealth went. The answer? Nowhere, because it was never anywhere. The global financial system processes $5 trillion a day in currency trades alone. Most of it is speculation, algorithms trading with other algorithms, money becoming a game that money plays with itself. And somewhere, underneath it all, there's a family trying to pay rent, a small business waiting for a loan, a student looking at their account balance and wondering if they can afford groceries this week. Real people trying to navigate an economy that stopped being real decades ago. Here's the thing about systems built on belief. They work brilliantly until they don't. The global money system we've created is efficient, powerful, and incredibly fragile. It's given us unprecedented economic growth and unprecedented vulnerability. Because when everyone's wealth is just a number in a database, you're one database error away from disaster, one cyber attack, one policy change, one loss of faith. The emperor isn't just naked, the emperor is imaginary. And we're all pretending together because the alternative is too uncomfortable to consider. So tonight, when you check your bank account again, remember, those numbers represent a promise that the system will keep running, that your bank will honor its obligations, that the currency will hold its value, that when you need your money, it'll be there. But promises, like data, can be rewritten. The question isn't if you trust the system. The question is, what happens when the system stops trusting itself?